In this video, we're going to talk about mutual fund and analyst performance in the context of the efficient market hypothesis. The philosophy here was that, hey, if we want to determine whether markets are efficient or not, let's go to the people who are paid. This is their full-time job, is to beat the market or to tell us which stocks to buy. So for example, mutual funds, if you're working for a fund, an actively managed fund, your whole job is to beat the market. So maybe if you can't do it, nobody can do it. And analysts, your job is to tell me which stocks are undervalued and going to go up. And maybe if you can't do it, nobody can do it. So let's go and see if the professionals, the people who are paid to do this every day, are actually beating the market and what they say about it. All right, so first I'm going to start with analysts. So who are analysts? Analysts, they often work for like a Wall Street firm, and they put out projections of whether a stock is going to outperform or underperform. Let me quickly show you where you would find these. So let's jump over to FinViz, and I'm going to jump in and I'm going to put, let's put Apple in here. And I'm going to scroll down on Apple, and I'm going to scroll down to this zone right in here. Okay, so this zone right in here, you can see me highlighting. These are the analysts, right? It says analyst right there, and it tells you what they're saying about this stock. So this was for Apple. We can see there's some red downgrades there. A lot of them are just reiterating, just holding their current projection on the stock. And they will say things like, this one, the downgrade, they were neutral. Now they say you should sell Apple. Others are still saying outperform, neutral, buy, hold. So they will give recommendations like that. That's what we're talking about with the analysts. And who do they work for? They work for like generally big investment banks. Okay, so jumping back to analysts, let's look at the results of the analysts. Are they actually any good? If you follow the analyst, do you make money? Do you outperform the market? Let's see what the research says. So just to give you sort of an overview of the results of the research, they say the following. Analysts tend to be overly positive about a firm's prospects. What does that mean? That means when an analyst says buy, maybe they don't really mean buy, maybe they mean hold. And then if they say like strong buy or outperform, maybe that's when they mean buy. So they said watch out because they tend to be a little more positive, a little more optimistic than they probably should be, okay? So the level of consensus is an inconsistent predictor of future performance. So that's the case, but watch for the following. They said changes in analyst consensus are associated with price changes. That's the one that is actually predictive. So how does that come up? Well, if you're looking at analysts, don't really look at whether they all say buy or not, but look at if some have upgraded. Maybe they were hold before and now they're moving up to a buy. So if a lot of them are doing that, then that seems to be a predictor. What we saw on Apple there was that a couple of them, I don't know if it's enough for you to actually take that into account, but a couple of them have actually downgraded, and these results would say, hey, that's what you should be watching. Some other results here. Positive changes by analysts were usually associated with about a 5% increase in the stock. So it did seem to be predictive, and negative with about 11% decrease. Other results did say that firms with the most favorable recommendations do seem to outperform at least a little bit the firms with the least favorable recommendations. Bottom line, if you try to summarize this, there does seem to be some value added from analysts, especially looking at whether they are upgrading or downgrading, not necessarily the current level that they're at, but how they've changed. But it's not clear that it's enough to overcome transaction costs if you trade based on every change in the analyst. So sort of some mixed results there. Let's now turn our attention to mutual funds or actively managed funds. These are the people who actually have the money and are being paid to invest and outperform. Let's see how they do in general. So first, sort of a summary result here. Only a minority, that is less than half, of managers' performance is sufficient to cover their costs. That is, compared to basically just a passive portfolio or the market. Actually, the majority, after you pay their fees, the majority lose to the market. So again, that's a negative result. It says markets seem to be pretty efficient. They're not, at least on average, beating the market. And there are various ways to show this. Here was one plot. This was sort of done in a more sophisticated way. It was actually a 4-factor model, and they were comparing the alphas of that. Like, did these funds actually have a positive alpha? Were they beating what was predicted from this? And it turned out that this is what the plot looks like. And on average here, when you include their fees, the majority actually lose. Okay, so again, this is a negative result, but here was the response to this. The response was that, well, when I'm investing, I don't need to invest in the average mutual fund. I'm going to find the good ones. Maybe that's these up here, and I'm going to invest in those. So maybe those are the good ones. Maybe those are the ones with the skill. I'll invest in those, and I will make money from them. So then the question is, these ones way up here, were they actually good? Do they have skill? Or are they just lucky? This goes back to the lucky event issue. And how would you try to test that? Well, let's see what they did. Here was the test. It was sort of like if somebody's flipping a coin and they flip a bunch of heads in a row and you're like, I don't know whether that was real or whether you just got lucky. How do you test them? What do? You say, okay, continue to flip me heads and I'll believe you. So here, what did they do? They took the best performers. Again, they bucketed these into deciles, that is into 10 buckets. And these were the top ones and these were the bottom ones here. And then they just said, okay, let's start you over and let's see how you do going forward. 1 year, 2 years, out to 5 years. What happened here? It turns out that those were the best, who were the best, basically dropped back into the pack. And those who were the worst actually come up into the pack. What does that make you think? Skill or luck? This looks a lot more like luck. If they had skill, you would hope that the best ones would stay the best. And if the bad ones here were really bad, just not unlucky, you would assume that they stay at the bottom. But no, after 5 years, they're all basically look the same again. So that seems to indicate more luck than skill. And that is supportive of the efficient market hypothesis, that it does look like it's very hard to beat the market and they were just lucky. There's another version of basically the same idea. This was looking just one more quarter into the future. So they rank them. These were the best. These were the worst. And then they look at them in the next quarter. What happens? Those that were the best actually drop down and look pretty much average. They're a little bit above. Those who were the worst come up and they look pretty much average as well. So once again, this seems to point to luck over skill. So a lot of these results, even when they go to the mutual funds, those who are being paid to beat the market, are very inconclusive at best, and in general point to the fact that it's very, very tough to beat the markets. Markets look very efficient. All right, so just to summarize here, are markets efficient or not? Enough that only differentially superior information will earn money. Basically, it's saying it's hard. It looks like it's very hard to beat the market, and a lot of the evidence points to the idea that markets are actually quite efficient. If professional managers are beating the market, then we're running into that magnitude effect. Then their margin of superiority is too slight for statistical significance. But there's definitely a lot of research going on, a lot of research into anomalies that seem to point to ideas that are potentially profitable and pointing to, does look like there are opportunities for trying to beat the market, but it's not easy. So at the end of the day, it looks like there's no free lunch here. It's not easy if you want to beat the market, and markets do seem to be pretty efficient. All right, we're going to finish it off by doing a couple of problems here. Which of the following most appears to contradict the proposition that the stock market is weakly efficient? Which one would violate weak efficiency of the market? See if you can do this on your own. I'm going to walk through it right now. Over 25% of mutual funds outperform the market on average. Insiders earn abnormal trading profits, or C, every January the stock market earns abnormal returns. Okay, let me give you an approach or a method for solving these problems. All right, so the first thing is, if it's asking us to find something that contradicts market efficiency, okay, what do we need? We need to be able to make money. So look at the answers and saying, hey, if I knew that, could I actually create a strategy that made money? So that's number one. So let's look at these and let's go through that as the first part. Over 25% of mutual funds outperform the market on average. Does that help me make money if I know that? No, unless I know which ones are outperforming. No, that doesn't help me. So that's not a violation of market efficiency. Insiders earn abnormal trading profits. Well, that does seem to be a violation, but a violation by who? That's a violation by the insiders. I'm not an insider. Okay, so this one would come up in the context of the strong form. However, here it's asking for the weak form. So let's look at C. Every January, the stock market earns abnormal returns. Could I make money based on that? Yes. Yes, I could. How would I do that? I just buy the market in January and it goes up and I make money. Okay, so that is a violation of the efficient market hypothesis. And which form is it a violation of? Well, you ask, what information do I need to run this strategy? In this case, what do I need? Well, I can just look at past prices, and I can look at them in January, and if they went up in January, that's all I need to run this strategy. Okay, so that's the weak form. Why? Because the only information it uses is past prices, right? And the weak form can use past price and volume information. So the answer to this one is C. All right, let's move on to the next. Which of the following observations would provide evidence against the semi-strong form of the efficient market theory? Okay, so once again, try this on your own. Use the framework that I mentioned in the previous problem. I'm going to go through the answer here. So again, if it violates efficient markets, we must be able to make money off of it. Okay, so that's the first thing we ask ourselves. And then we look at the specific form they're asking for, the semi-strong, and we ask, what information can I use to make that money? And the semi-strong is, as long as it's public information, you're good to go. Okay, so let's walk through those steps. First one, mutual fund managers do not on average make superior returns. Does that help me? Can I make money off of that? No. So that one's out. You cannot make superior profits by buying or selling stocks after the announcement of an abnormal rise in dividends. Again, that doesn't help me beat the market. Low price to earning stocks tend to have positive abnormal returns. That I could use to make money. How? I'm going to have in my portfolio low price to earning stocks, and I want to make those abnormal returns. So that satisfies, at least there's a way to beat the market from that. In any year, approximately 50% of pension funds outperform the market. That doesn't help me unless I know which 50%, right? So this one we have C, and does this fall under the semi-strong form? What information do I need? I need price to earnings ratios. Is that public information? Yes, so my answer is going to be C. All right, let's do one more problem. Hopefully you're getting the idea of how to solve these. Which of the following phenomena would be either consistent with or a violation of the efficient market hypothesis? Once again, if it's a violation, you have to be able to make money from it. If I can't make money from it, okay, it's not a violation. So let's look at these. And let's take these one by one. Nearly half of all professionally managed mutual funds are able to outperform the S&P 500 in a typical year. Knowing that, can I make money off of that? You think about it, no, because I don't know which half. Okay, that's just like a flip of a coin. Some are going to beat, some are going to lose to the market, but I don't know which ones. So this is actually consistent with the efficient market hypothesis. I can't make money off of it. B, money managers that outperform the market on a risk-adjusted basis in 1 year are likely to outperform in the following year. Could I make money off of knowing that? So I think about it for a little bit, and the answer is, yeah, I think I could. How would I do that? I'm going to find the money managers that outperform the market, and then I'm going to invest with them for the next year, and they outperform or beat the market. So that would seem to be a violation because I could make money from that. This would be a violation of the semi-strong form. Why? Because that's public information. I can look up how different money managers did with the funds that they managed. So this would be a violation. I'm going to put a V there for violation. The stock prices of companies that announce increased earnings in January tend to outperform in February. Could I make money off of that? Yeah. I'm just going to buy those that had the increased earnings in January. I'm going to buy them and hold them in February. So that is definitely a violation because I could make money. Violation of efficient markets. And the last one, stocks that perform well in 1 week perform poorly in the following week. Could I make money off of that? Think about it. Yeah, so I'm going to find those stocks that performed well in 1 week, and what am I going to do? I'm going to short them the next week, and I could make money off of that. So that would also be a violation. That would actually be a violation of the weak form because I'm just looking at prices, right? So there you go. The answers are given here on this slide. I said them in words as well, but you're welcome to look through these also.